The U.S. stock market is currently closed. As of the closing bell on Tuesday, October 14, 2025, shares of Astera Labs, trading under the ticker symbol ALAB, finished the session at $63.30 per share. This represented a significant drop of $2.09, or 3.20% for the day. While a single-day decline of that magnitude might seem like standard volatility for a high-growth tech name, it hides a much more telling and, frankly, more concerning reality that most retail investors are missing. The expectation was that Astera, as a critical supplier in the artificial intelligence data center build-out, would be insulated from broader market jitters. The reality, however, is that a powerful mechanical force is at play, one that has nothing to do with AI demand or the company's technology, and everything to do with the simple, brutal arithmetic of post-IPO share structure. We are witnessing the market begin to price in the impact of the impending lockup expiration, a period where the dam of insider and early investor shares is about to break, and the potential flood of new supply onto the open market is creating a palpable sense of anxiety among institutional holders. Most people see Astera Labs and think it's a straightforward bet on AI. They see headlines about the demand for NVIDIA stock and correctly assume that the ecosystem supporting those GPUs must also be thriving. Astera provides the essential connectivity fabric, the high-speed data lanes that prevent bottlenecks in massive AI clusters. It's the plumbing that makes the entire system work. The common belief is that you can simply buy this stock, perhaps through your Fidelity Investments account or by using the SoFi trading platform, and ride the coattails of the AI expansion. That narrative is powerful, and for a while it was true. The stock saw a meteoric rise after its public offering. But to continue holding that belief now is to ignore the structural overhang that is currently defining its trajectory. The challenge to this simple thesis is that Astera is no longer just an AI growth story. It's now a case study in post-IPO market dynamics. The forces of supply and demand are not about its products right now, but about its shares. The big funds, the ones that dictate price action, are not asking about Astera's CXL technology roadmap this week. They are calculating the exact number of shares that will become available to trade and trying to get ahead of the inevitable selling pressure. This isn't a story you'll piece together by just looking at a chart on the Robinhood app. It requires a deeper understanding of market mechanics. Let's dissect the recent stock movement with this lens. The 3.20% drop yesterday was not an isolated event. It's part of a broader, more painful pullback from its all-time highs of over $95 per share. The trading volume on these recent down days has been particularly telling. We're seeing elevated turnover, suggesting that larger blocks of shares are changing hands. This isn't just skittish retail investors using their individual brokerage accounts to sell a few shares. This pattern often points towards institutional distribution, where early-stage funds or large holders begin to methodically lighten their positions in anticipation of a significant market event. In this case, that event is the lockup expiration. For those unfamiliar, when a company goes public, insiders, employees, and pre-IPO investors are typically locked up, meaning they are contractually forbidden from selling their shares for a set period, often 180 days. This is done to prevent a chaotic collapse in the stock price immediately following the IPO. Astera's lockup period is approaching its end, and the market knows it. Suddenly, millions of shares, whose owners are sitting on enormous paper gains from venture capital funding rounds where they invested at a fraction of the current price, will be eligible for sale. Even if only a portion of them decide to sell, it dramatically increases the available supply, or float, of the stock. For an online investment professional, this is a glaring red flag that signals near-term turbulence, a stark contrast to the smooth upward trend many expected. This isn't a phenomenon unique to Astera. We've seen similar patterns in many tech IPOs. The key is to recognize that the stock's performance in this phase is less about its fundamental value and more about absorbing this new supply. This pressure is compounded by the performance of the broader semiconductor sector. The Van Eck Semiconductor ETF, SMH, has been choppy, facing headwinds from persistent inflation data and uncertainty around the Federal Reserve's interest rate policy. When the entire sector is struggling, it's very difficult for a single stock, even one with a compelling story like Astera, to swim against the tide. This is a classic example of how macroeconomic factors can temporarily overshadow company-specific fundamentals, a crucial lesson for anyone engaged in self-investing. Furthermore, the competitive landscape is not a vacuum. While Astera has a strong position in PCIe and CXL solutions, it competes with behemoths like Broadcom and Marvell Technology. These companies have deeper pockets, longer-standing relationships with customers, and much broader product portfolio. Any sign of intensifying competition or pricing pressure can make investors nervous, especially in a risk-off environment. Traders using sophisticated platforms from interactive brokers are watching the order books and options activity closely, and the sentiment has clearly shifted from unbridled optimism to cautious observation. So, what exactly does Astera Labs do? In simple terms, they build the traffic control systems for data inside AI supercomputers. When thousands of GPUs, like those from NVIDIA, are working together, they need to share immense amounts of data at incredible speed. Astera designs and sells semiconductor-based connectivity solutions, like their Aries PCIe Smart DSP retimers and their Taurus Ethernet Smart Cable modules that ensure this data flows without bottlenecks. Their business model is fabless, meaning they design the chips but outsource the expensive manufacturing process to foundries like TSMC. This allows for a focus on research and development, but also exposes them to the complexities and potential disruptions of the global semiconductor supply chain. Before going public, the company showed staggering revenue growth, which is what fueled the immense hype around its IPO. Their initial earnings reports as a public company have continued to demonstrate this growth, but the market's reaction has become more muted, a sign that investors are now weighing that growth against the stock's high valuation and the aforementioned structural overhang. It's a classic tension between a fantastic business and a potentially troubled stock in the short term, a distinction that many new to online investing often struggle with. Looking ahead, the future outlook presents a fascinating dichotomy. The long-term expectation, the narrative that originally captured Wall Street, is still very much intact. The build-out of AI infrastructure is a multi-year, if not multi-decade trend. The demand for data connectivity solutions is not going away, it's accelerating. Astera's biggest catalyst is the widespread adoption of Compute Express Link, or CXL. This is an open standard interconnect that allows CPUs, GPUs, and memory to be pooled and shared much more efficiently. If CXL becomes the industry standard, and Astera maintains its leadership position in developing CXL-based products, its addressable market could expand massively. This is the story that long-term bulls, perhaps those building positions in their Fidelity IRAs or using automated tools like Schwab Intelligent Portfolios, are focused on. They are looking past the current noise, believing that the company's technological edge will ultimately win out. However, the reality of the near to medium term is fraught with risks. The primary risk, as we've discussed, is the selling pressure from the lockup expiration. The question is not if it will happen, but how much selling will occur, and at what price level the stock will finally find stability. A second major risk is customer concentration. A significant portion of Astera's revenue comes from a small number of large cloud service providers. While these are the best customers to have, this concentration creates a vulnerability. If one of these key customers decides to dual source its components, or even worse, develops its own in-house solution, it would be a devastating blow to Astera's revenue and the market's perception of its competitive moat. This is a risk that cannot be understated. Many investors who have seen the explosive gains of stocks like Tesla stock or the steady climb of Apple stock might not fully appreciate the fragility of a company that is still in its hyper-growth customer acquisition phase. This is where active management and due diligence, whether through a Fidelity wealth management service